So for some people, you can hold pension. Your pension is an example of investment account. Okay, it's just a what we call a wrapper. Then some people, you can also have what is a stock and shares ISA. The stock and shares ISA is another wrapper. Okay. Then you can have a stock and share lifetime ISA. This is another wrapper. And you can have what we call the general investment account. And the first three operate a little bit different from the last one. The first three are usually invested tax-free in the UK. So it means that whatever you put in as they go in, they are not taxed. And as they come out, other than pension, your stock and shares ISA, your lifetime ISA is not taxed as it goes in and as it comes out. So you can be an ISA millionaire and you will not pay any tax on that which you have invested. Okay, so let me just quickly recap. Usually, you can have a pension, you can have a stock and shares ISA, you can have a stock and share lifetime ISA, you can have a general investment account. Your pension with your employer, for example, or you can decide to have a self-invested pension. In this case, the money you put in will receive tax relief at source. And it means that if you put 80, if you're a basic rate taxpayer in the UK, you put 80 pounds in, it becomes £100. So that money goes in tax free. And if you can invest it over time, that £100 can become £300. So by the time you are taking out that money at 55, 58, 60, for example, you can get a tax-free allowance. And if you take more than maybe 25% at the moment, whatever is above 25%, it becomes taxable. Okay. Now, that is how the pension works. Going in, tax-free, growth, tax-free. At the point you are taking it out, it can be taxable depending on your personal circumstances. Stock and shares ISA, stock and shares lifetime ISA goes in tax-free, comes out tax-free. Okay. Then the general investment account goes in tax-free, comes out taxable. So if you have a general investment account, it's all everything, your income, your profit or your growth can be taxed in the general investment account. All right. Now let's talk about two approaches to investing. There are basically three, but two mainly. The first one is the passive investment or investing strategy. Now, what does this mean? It means that you buy a fund which tracks a particular index. Okay. In this case, it's called index investing or mutual fund investing, depending on where you are around the world. But here, you are not trying to beat the stock market. You are only trying to perform as good as the stock market. So if the stock market that you are tracking as index goes up by 5% in a year, your portfolio goes up by 5% or around 5%. So for example, the FTSE 100, that is the top 10 UK biggest company, is an index of its own. S&P 500, which is the top 500 companies in the UK, in the US, is also an index on its own. So if you invest in those, it means that you are trying to perform in the same way as those companies have performed in over the year. Now, active investment or investing is a little bit different, but the difference here is that you are actively buying and selling assets with the hope of getting a higher return. Now, what does this mean? You might think, okay, from what you know as an individual, you think Tesco will do very well. Okay. If you think Tesco will do very well in 2020, in this 2025, so you might decide to buy Tesco. If you buy a shares in Tesco and that shares goes up by 10%, you might think, well, from what you are seeing, it's likely that Tesco will have, with the shares will go down in the nearest future. Then you decide to sell it and get 10% profit increase. Then if the price did go down, then you can go back in, buy it at a lower price with the hope that it will get better in the future. So this is what active investing is. It means that you are buying and selling assets with the hope of getting a better return. Now, there is a trade-off here. in the sense that the more you buy, depending on your platform, you can get charges for buying and selling. In the UK, if you are buying and selling assets as well, you can also be paying stamp duty on those assets. Then some platform also charge you for every trade that you make. And this is where it is very important to consider charges when you make up your mind as to what to invest in. So if you decide to buy different shares of different companies, then in that instance, you are becoming an active investor. But to be an active investor requires a lot of work. It means that you have to be checking the news, checking the company fact sheet, checking the company financial statement to see whether they are doing very well or they will probably have issues in the future. But then if you are not a stockbroker, you also have a different day job, then it becomes very difficult for you to continue to stay on top of things because you have other things doing, you have work, you have family. So that is why most people, personally, I myself as an individual, prefer the passive investing. The passive investing is more like a set and forget. You just say, okay, I want to invest in this fund on a monthly basis. You send money in by direct debit, and you just forget it there. You don't really care about it. You don't even need to check it every day. Just set and forget it. Of course, you can go back and say, okay, what do I need to do? Do I need to increase how much I'm buying, or do I need to increase how much, or the fund that you are buying, as your case might be, or as your situation changes. But the passive investment means that you can go on doing your day-to-day job, living your life while still investing without you even thinking about it. So, for example, for myself, I've mentioned it over and over again here. At the beginning of the month, on the first day of the month, the money that goes into my investment goes out of the bank account even before I wake up. If it's a weekday, the money that I give to support church goes out of my account, even if it's not a Sunday. I just go to church on Sunday to fill the envelope once, and that is it. So you set it, automate it such that you don't need to think about it. And that really makes life easier for you. You can then focus on your day-to-day job, doing other things without even worrying about your money. Okay, so let's proceed. Then the other one, which we can talk about, is the robo investor. For example, if you have account with Nutmeg or I think Moneybox, for example, what most of them do is they buy passive fund and then they put it together, combine it together, and then they offer it to you as beginner, intermediate, advanced, and then people buy their own fund. But what they are doing is they are buying underlying passive investment tracker fund, and then they will charge you again for platform fee and so on. So the best thing you can do is to do it yourself by doing passive investing rather than going to use other people to do it for you. On this chart, I've presented, a few difference between passive investing and active investing. Now, I've mentioned them during the explanation, but generally, passive investment has lower fee compared to active investing. So here, you have to pay the fund manager, you have to pay for stamp duty, you have to pay most time and transaction cost as well. Then, in terms of the time horizon, for someone in passive investing, you are in it for the long run. You are in it for 30 years, 20 years, as the case may be. But for someone doing active investing, most times they are buying when it appears to be low, and then they sell when it is high, and so on. So again, different people have different tastes. But for most people, if you're a long-term investor or you don't want to worry too much about your investment, then passive investing might be the one for you. But if you are experienced, you want to buy other assets, you just want to play around with it, then you can explore passive active investing. And there's nothing stopping you from doing both. For example, I have on my platform, I have the option of having a passive investing. I also have the option of doing some active investing. So some times ago, I think when I had a lot of time on my hand, I was trying to do some active investing as well. But then over time, I do not have that time. So I just decided to rebalance my position and move into passive investing, which is more of a set and forget. Just do it once and let it go. Let it run by itself. Okay. Now, in summary, For many people, your best bet is to go with passive investing. Many people try to beat the stock market, but very few beat the stock market. Not everybody can be like Warren Buffett, who can identify gaps and see that companies before they even take off and buy position in them. For some people, they end up losing money because of their decision. So if you want to stay safe, get your return as much as possible. Just focus on passive investing. How should you invest? And I think this is very the important bit here that I want to emphasize. Now, there are three things that you need to know. To invest or to start investing in the stock market, you need, number one, the platform. Okay, you need the platform. Now, the platform is usually companies where you have an investment account with. For example, you can be Vanguard, Fidelity, Agri Lansdowne, Invest Engine, Trading 212, Free Trade, Moneybox. There are different ones in the UK, for example. There are different ones in the US, in Nigeria, for example. But there is a platform that where you invest. Okay. Then after that, you have what is called a wrapper. Your wrapper can be an ISA, can be a pension, can be a general investment account. That is where you are putting the money. Then inside your wrapper, you can then have your investment. And in this case, you can have ETF, you can have index fund, you can have shares of companies, you can have bonds, everything within your investment. But these investments are in a wrapper, and this wrapper will be with a brokerage or a investment company. Okay, so this is how it usually lay out for you. Now the question is, what are the key considerations when you want to choose your platform? Okay, to choose your platform, very importantly, your charges is very important. Now, different platform has different charges, for example. Now, recently, Vanguard has increased how much they charge for investors. They are going to, at the end of this month, they'll be charging £4 every month, for having your investment with them. But there are others like Trading 212 that doesn't charge you. So if are you happy with paying £4 to a company, or going to a different company that will not charge you 20 that will charge you zero on a monthly basis? So those are things you have to consider. Then in some cases, where you invest in also depends on what you want to invest in. So for example, you want to invest in stock, or you want to invest in funds, but the funds you want is not on the platform that charges zero, but it's available on the one that charges £4. So do you like that fund so much, or you think it will help you to achieve your goal so much that you choose to go with the one that charges you every month, or the one that charges you nothing, but you can find an alternative that is as close as possible to what you really want? Then some platforms are more user friendly than others. For some, they look like they have been made since before I was born. But some, they are very intuitive. You see it tells you, oh, if you invest this, like this, you can see how much you will get in the next 30 years. They are very attractive. So what is important to you? Do you want functionality? Balance that with cost, or you want something that looks very beautiful, that shows you the graph, you can see how your portfolio is going? Is that what you want? You also need to check this before you decide which platform. But I think most importantly, for many people in the UK, what is more important is there a regulatory safety? So every firm that is regulated by the Financial Conduct Authority in the UK also has, most times, the FSCS protection. So here, your investment is protected up to 85,000. So if anything happened to that company, you can be sure that you will get 85,000 back out of your money. That is, if the company that you are investing in, that is regulated, goes into bankruptcy or they close, this does not apply to if the fund goes down by 85,000 and the company is still in existence. But if something happens to the company and the company closes, then you can get up to 85,000 back. So always check if there is a financial or regulatory safety that can help you to reclaim your money if something goes wrong. Now, the next thing to consider in terms of wrapper is tax efficiency. Like I mentioned previously, you can in your ISA, your money that you put into an ISA can grow tax free, and then when you take it out, there is no tax. In your pension, your money goes in tax free. In fact, you can even get tax relief on it. But then when you come back out when you are retired, you pay some tax on it. Then if you look at the general investment account, the money goes in tax free, but when you are taking it out, you have to pay tax on it. Okay. Then the other thing is your investment goal. So to determine your wrapper, you need to decide what is your investment goal. For some people, they think I won't be needing this money for the next few years, so just put it in a pension and forget it there. So because they don't need the money for 20 years, 30 years, they are happy for it to be in the pension. For some people, they might think, okay, I have to put it in an ISA because I can take out the money tax free when I need it, if I do need it. But at the same time, they want that flexibility. So for some people, they want the flexibility. For some people, they think, I don't need the money now, just leave it there. So your goal determines where you put your money. For some people, they can decide to split it 80-20, 80% of your investment money in your pension, 20% in your ISA. So depending on what you're comfortable with, and you can always make changes every time you do your review. So every year, every quarter, but don't do it every day, don't do it every week, and don't do it every month if you can. So give it time, maybe watch it every quarter or even every year maximum. Just do it every year, once a year, and then decide, okay, next year, this is my goal. I need to move things around. Go ahead, do it at that point, and then you can progress with that. Again, if you have any question, do put that in the chat. Then contribution limit. So for example, your ISA, you can only put maximum of £20,000 in an ISA in every tax year. In your pension, you can put maximum of 60,000 in your pension. So for some people, they have 20,000, they already maxed out their ISA. In fact, at this point in time, some people have maxed out £20,000 for the tax year already. Then they say, okay, I still have some money, put that in your pension, and you can put up to 60,000 in your pension. So it means you can save £80,000 tax free in the UK without the government looking like, what are you doing? Okay. Then if you, for example, if you have more than 80,000, you've maxed out your pension, you've maxed out your ISA, then you can decide to put money in your general investment account. Here, you can put millions in, nobody cares. But then when you take out the profit, you can be taxed on that. Then also the flexibility. ISAs and general investment account, you can easily access to withdraw your money when you need it. But pension, you have to wait until either you are 55 currently in the UK, or an individual is terminally ill, or there is a death, and then the income or the pension can go to your surviving dependents. And this is why it is very good, if you have a pension, make sure that you are updating your dependents on your pension. Because some people, they passed away sadly, but then they have no record of their dependents. So the money is just sitting down there without, and their families are struggling. So if you want, you can do it today. Log into your pension provider, set it that, okay, if you're married, set it, and you don't even need to think about it too much. Just set it 100% goes to your wife, or as a husband, or 100% goes to your husband as a wife, and such that if anything happens to you, they have access to that money, and then they can continue living life, supporting your joint goal as a family, even if you are no longer there. So in terms of investment, what are the key things? One is that your investment goal. So for example, if you want a set and forget that you don't need to worry too much about on a monthly basis, on a yearly basis, just go with the passive investment. Do it once, forget it, set the direct debit, let it go out every year, every month, and the case maybe every week for you, and just continue doing other things. For some people, their goal is I want to beat the stock market, I want to pick the stock. I like Nvidia, I like Tesla, I want to buy the stock by myself. Yes, they can do that. Such people tend towards active investing, but you must be mindful of cost and fee. So you must be sure to compare the fund expense ratio. How much will it cost you if you hold this fund? And depending on the cost and the platform fee and so on, all those costs determine which one is best for you. And sometimes the performance can also vary. So check that to see which one is best for you. And the other part is diversification. You see, many people says, "Oh, I like Nvidia," so they put £1,000 in Nvidia. But then, if you remember, when DeepSeek came out, Nvidia shares went down. Why? Because there's a rival, a new kid in the block, a rival in the block, and because of that, they lost some money at that point in time. So the purpose of diversification, like the Bible says in that scripture that we read earlier on in Ecclesiastes chapter 11, it says that invest in 8 venture or invest in 7 venture. In fact, invest in 8 because you don't know what will happen. So if you are able to invest in different options, it helps you to diversify your portfolio. So if a company fold up, for example, like some companies that have gone bust or gone bankrupt, then you don't lose all your investment. So this last one is also very important if you decide to go into passive investing. Be sure to check the tracking error. So most of the index funds or the ETFs, they want to match the benchmark, that is the index that they are following. So you need to be able to check. The better the performance or the more it matches that index in terms of annual returns, 5 years return, 3 years return, the better. So if it's lagging or is far apart, it means that you are not really performing as well as that your portfolio should be. There might be other options for you to explore.